Investing is a long-term game. It takes time to build wealth with investments, and for many investors, it's easy to get discouraged or frustrated by lack of early results with their investments. That's where dividend investing comes into play. Dividend investing is both an investment strategy that can give great results, but also one that can boost your motivation along the way. Warren Buffett is one of the best investors of all time, and dividend investments are a great part of Warren's investment philosophy and wealth creation. In this video, we'll explain why dividend investment is so powerful, especially if it's done right. We call this the double snowball effect. This is investing in a nutshell. Let's start with basics. If a company makes a profit and wants to distribute its gains to its shareholders, it has two main options. The company can either pay dividends or it can start a share buyback program. In a nutshell, share buybacks are when companies buy stocks from the market, reducing the number of shares in circulation. That makes each share represent a larger portion of the company, and thus increase the value of each share. We'll cover share buybacks in more details in a future video. Dividends, on the other hand, are a portion of a company's profits that are paid out to its shareholders on a regular basis, usually quarterly or annually. In most cases, we see dividends in the form of money, but it's also possible to issue dividends in the form of shares. One group of stocks that is particularly attractive to dividend investors are the so-called Dividend Aristocrats. These are companies that have a long history of paying steady and growing dividends. In order to be considered a dividend aristocrat, you need to increase your dividend every single year for 25 years straight. The companies that have managed to achieve this title know how valuable it is and will keep the streak going if they're able to. The dividend flow is therefore predictable and something you can often count on. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble are examples of dividend aristocrats with a track record of increasing dividends for 60 years. The true power of dividend investing lies in the compound dividend growth rate. This is the rate at which the dividends paid by a company increase over time. The higher the compound dividend growth rate, the more income you'll receive from your investments over time. This is why dividend investing can be so powerful, as it creates a snowball effect where your income grows and grows over time. It's important to keep in mind that you don't see dividends or the dividend growth rate if you just look at the share price of a stock. You need to dig a bit deeper, but more on that in a bit later in this video. Another important factor to consider when investing in dividend stocks is the expected stock price growth rate. While dividends are a great way to receive a steady stream of income, it's also important to consider the potential for appreciation of the stock price. Companies that pay a steady and growing dividend are often well established and financially sound, which can increase the likelihood of stock price appreciation over time, especially if the company also increases the dividend consistently year after year. This has the effect of compounding your wealth, as you're able to earn income from both dividends and the stock price appreciation. This is the double snowball effect, increasing yearly payments in the form of dividends and increased value of your stock portfolio. Are there any strategies we can implement that can make dividend investing even more powerful? Yes, there is. One of the biggest decisions that dividend investors face is whether or not to reinvest their dividends. When you reinvest your dividends, you use the income you receive from your investments to buy additional shares of stock. On the other hand, if you do not reinvest your dividends, you will receive a steady stream of income, but you'll miss out on the compounding effect from the dividends. You must make your own financial decisions, but our simple advice here is to not miss out on the compounding effect. The long-term difference between reinvesting the dividends or keeping it as cash is surprising. If you found a company with sound financials, a company with a bright future, and a consistent flow of increasing dividends, consider reinvesting. Let's explore why with a few real-world examples. Investor legend Warren Buffett has done many amazing investments, and one of them was actually in Coke. Warren Buffett bought more than $1 billion worth of Coca-Cola company shares in 1988, an amount that was then the equivalent to 6.2% of the company. The purchase made it the single largest position in Buffett's Berkshire Hathaway portfolio at the time, And Coca-Cola stock remains one of Berkshire Hathaway's biggest holdings today. The holding company currently owns a 9.2% stake, worth more than $22 billion in the company. Berkshire Hathaway bought the stock for $2.45 per share in 1988, and Coke has since paid $25.36 in dividends per share. 10 times the invested amount has been returned as cash. And that is with no dividend reinvestments. In 2022, Coke paid its shareholders $1.76 per share, equaling 72% of the original investment for Warren Buffett in dividends in just 1 year. In addition, the stock price has risen from $2.45 to $60 as of the recording of this video. That is 25 times return in 34 years, excluding any profits from dividends. How much difference does it really make to reinvest the dividends? Let's say you invested $1,000 in the beginning of 1988 in the Coca-Cola company. The share price at the time was $23 per share, leaving you with 43 shares in total. If you chose to not reinvest any dividends, you would still end up with $10,142 in dividends throughout the years, and an ending stock balance of $22,688, giving you a net profit of $32,830. Impressive, but what do you think the net result would be if you had chosen to reinvest all the dividends in Coke? Your share count would increase from 43 shares to 89 shares, and the ending balance as of today would be $46,336. A staggering 46 times return in 34 years. In the same time period, the S&P 500 has increased 16 times, a solid outperformance. Warren Buffett has become rich from dividend investing, and many investors get tremendous motivation and encouragement from the quarterly payouts. It's also a cherished investment strategy for retirement portfolios and investors who live off of their investments and need regular payments. How do you get started with dividend investing? It's difficult to find the right set of stocks that both has a bright and safe future and pays good dividends that are increasing year after year. You need to take your time and do a lot of research if you want to have great results as a dividend investor. But there's an alternative. Can you guess what? It is, of course, an index fund, or ETF in this case. There are several ETFs tracking dividend companies, and one popular example is the Schwab U.S. Dividend Equity ETF, with ticker symbol SCHD. This ETF invests in companies that pay steady and growing dividends, and it has outperformed the broader market the last few years. The key to the success of SCHD is its focus on companies that have a long history of paying a steady and growing dividend, which has resulted in a compound dividend growth rate that has outpaced the broader market. The double snowball effect. If you prefer to invest directly in companies instead of using an index fund or ETF, a great start is to check out the Dividend Aristocrats. They have the track record, but remember that past performance is no guarantee for the future. You still need to do your own due diligence and analysis to figure out if the company is worth your investment. To summarize, dividends are one of the ways a company can distribute parts of its profits to its shareholders. Dividends are usually paid in the form of money, but can also be in the form of shares. Companies with growing dividends will often experience a double snowball effect, with both an increase in the dividend itself and the stock share price. Combine this with dividend reinvestments to achieve amazing results. We hope you've enjoyed this video and that it has inspired you on your own path to dividend investing. If you have any questions or feedback, leave a comment. And if you haven't subscribed yet, make sure to do it so you don't miss out on any future content. See you in the next one.